Hi everyone. So there's actually two main methods whereby we can make money in the stock market when it comes to investing. The first way is to invest in companies whereby it's likely to revert to the mean, and the second way is to invest in compounders. So what do I mean by investing in mean reversion? It usually happens to companies when bad things are happening, both either on an individual level or on an economy as a whole. So take for example, banks in 2008 financial crisis. When there was a big financial crisis that was sending many of the banks to bankruptcy, such as Lehman Brothers or Bear Stearns, for example. They required a lot of government intervention, but not all banks are bad per se. When it comes to investing in this company, usually when the stock market starts panicking, it's going to deviate very far from the mean. Meaning, when we look at a certain valuation, for example, the Singapore banks have a tendency to trade around price to book of 1. And we saw in those times whereby the price to book will swing very far down from what they usually trade at, from usually price to book of 1 all the way down to 0.5 or 0.6. At that point, this is when Mr. Market is in a severe panic mode, and I think those are actually good times to start scooping up on shares like this. This doesn't just happen with banks; it's also quite common with developers, because properties is quite cyclical in nature. Industries that are cyclical in nature have a good chance of swinging to the extreme every now and then, because the Mr. Market always overreact. I tend to use price to book for these asset heavy companies, like banks and property, because when it is swinging downwards, away from what the valuation they usually command, earnings is not really good indicator, because there's usually losses write off and stuff. What we want to focus on is the assets that would be generating this stream of cash flows in the future. So for example, property developers, during the Hong Kong protests, for example, back in 2018 or 2019, many of them saw their business being severely affected. But we know that protests in Hong Kong, or even Thailand for that matter, is a very common thing. It comes and it goes. So as an investor, if you take the view that this is not a permanent scenario, you can consider focusing on the worth of those shopping malls and buildings. And over time, when the protest is over, Mr. Market will then re-rate the valuations of these developers upwards, back to usually where it was traded at mean. And it is also common, like when we see property prices started to go way up, then sometimes they may swing way above mean, meaning they trade way above what the valuation they command in the long term. And that is probably a good time to start selling our positions in these companies. So the thing with investing in companies based on the concept of reversion to the mean is that once its valuation has fully realized, you have to move on to the next one. So for example, when you look at banks and developers, you're not going to see them grow very fast because of how asset heavy they are. When I say they are not going to grow very fast, I'm comparing to the compounders, which I will talk more about later, whereby they don't require much capital investment to grow. So these are the companies that you will see huge appreciation in share price. So the thing with mean reversion is that they usually would give you a good 100 or even 200% returns. The key to think about this is how long would it take for it to mean revert. For example, during the financial crisis, I believe most of them mean revert within 2 to 3 years. So let's say if you made 100%, you doubled your capital within 3 years, for example, then you are delivering a very decent 15 to 20% compounded annually, 15 to 20% IRR. So that's quite decent. But imagine if it took 5 to 6 years instead, then the IRR in that case may not be very satisfying. And once it fully realizes its valuation, then usually that's the case whereby you have to move on to find another company who's currently suffering a big drawdown. But we also have to be careful with these companies because sometimes it may be a melting ice cube, or what many would call a value trap. Sometimes the share price go down and valuation starts shrinking for a good reason, especially when the company is being displaced. So don't be drawn to companies like Press Holdings, for example, the newspaper companies, especially if they don't innovate. In Singapore, there is companies like SPH or SingPost, for example, whereby technology disruption has completely disrupted their business model. They are not going to be worth what they used to be worth in their heydays, and in this case, in this scenario, it's unlikely their valuations will ever revert back to the mean. It's likely going to stay low for a very, very long time. So take note, when we are investing in reversion to the mean, we want to invest in businesses that logically they are still strong, but the market is temporarily discounting them due to a short-term issue. Now, the next way to profitably invest in the stock market is by investing in compounders. So what I mean by compounder, these are companies who are able to invest their earnings, their money, their capital into very profitable endeavors in order to grow their business, right? They are able to continuously reinvest to grow their earnings in the future. And as we know, when it comes to investing, the share price is going to follow earnings sooner or later. And when I mean earnings per share. So it's important to take into account any other factors, especially when it comes to companies who are always heavily diluting their shareholders. So earnings, share prices will follow earnings per share in the very long run. And companies who are able to grow in this way without requiring too much capital will benefit, will really create life-changing wealth for shareholders. So a lot of these companies are what we often see in my articles on steadycompounding.com. If you read about MasterCard or Amazon, these companies don't require a lot of money to grow. For example, Facebook and Google, when they try to acquire an additional dollar in advertisement revenue, what is the amount of incremental cost they have to incur, right, when to gain that new customer? They actually don't cost a lot of money to acquire customer. In fact, I don't think it costs anything. As an advertiser, if today I want to go onto Facebook or Google to advertise for my blog, I simply fill up a form, put in my credit card number, and Facebook will start collecting payment for me. There's no content cost for them. There's no cost in acquiring me as a customer, right? They basically just sit there and wait for money to come in. So this is the kind of business that will generate a lot of money for shareholders because they don't require a lot of capital to grow. And whatever amount of money they put in, they're able to put into projects, different projects that's able to create even more revenue for shareholders. So this is typically the kind of business models I try to go for. And throughout my investing journey, I started out first investing a lot of companies that's I'm going for reversion to the mean, because typically a lot of these companies are asset heavy and it is easier to value. But over time, you don't want to keep going in and out of investment, because for reversion to the mean, once you made money on that particular piece of investment, you have to start looking for another one. Whereas for these compounders like Starbucks, Amazon, Facebook, Google, they are able to generate shareholder wealth at a very high clip for a very long period of time. I mean, if we were to take Amazon for example, right? For the past decade, if you have invested in Amazon, it would have delivered 32% IRR to you. 32% compounded annually is a huge sum. $10,000 invested in Amazon 10 years ago would generate a life-changing, $164,000. So this is the kind of opportunities we want to go for, especially if we are looking to compound our wealth for a very long period of time. Alright, so that's all I have for you today. If you enjoyed this session, do hit the subscribe button. And if you want to follow me on my blog, you can head on to steadycompounding.com and hit the subscribe button. Alright, that's all I have for you today.